Ladies and gentlemen of the crypto space, we're live on Monday, September 18th at 11:31 a.m. The flows are coming. Everything in reality operates cyclically. Ups and downs and bobs and weaves and forward and back and left and right and A and B, Team A, Team B, Republicans, Democrats, everything is cyclical. Everything's also binary as well. So we can draw a couple of inevitabilities based on that. And what's fascinating is projecting into the future how that cyclicality plays out in a changing environment. We know things are changing, and we could be very specific about many things. And based on how things are changing, I expect that cyclicality to be very interesting. And, hopefully earlier part of 2024. Hopefully we don't have to wait until, 2H 2024, Q3, Q4. I don't want to wait that long. I myself have expressed on Twitter that it'd be nice to catch some flows sooner than later. And I think they're coming. I think the flows are going to bolster price points from a value evaluation standpoint for things that are actually meaningful from considering how things are changing in the world. And these flows that will come in are not necessarily because of the exuberance that everyone says of, oh, they're QEing and they're the money printer, go burr. I don't need any of that juvenile bullshit. What I need is to understand that that liquidity will inherently improve for a variety of reasons. There's plenty of liquidity destruction scenarios in the short term, but in the mid to long term time horizon, and long term is probably 2025 in my mind with regard to this statement, the capacity for increased liquidity conditions is huge. As cyclicality plays out with credit and business and manufacturing, so on and so forth, there's always a bottom. And depending on how butchered the economy is, it could be a suppressed run to the upside with regard to what we typically see in credit and what we typically see in business cycles. But that's not necessarily how I've talked about and structured the portfolio of late. I'm not necessarily interested in the exuberant returns that in the past I myself and obviously many new entrants and still many participants in many markets are looking for. I'm more interested in the flows of capital and to capitalize on volume and consumption, fees. Now, that obviously has negative overtones of being a rentor, but shit, that's kind of what I want, and that's what has been presented as opportunity. So my expectation is probably a muted upside for a variety of reasons, including the potential for capital destruction. Not the word recession, but, like a swath of bankruptcies greater than what we've seen thus far is possible. I mean, what we've seen thus far is the largest since '08, easy, since 2000. I think I saw, if I recall correctly, the data that I saw earlier. Largest swath of bankruptcy since 2000 in 2023. So I guess the point is we're well positioned, and I'm very comfortable, and I'm expecting potential downturns in the short term, but I expect those flows to basically keep us where we are. I don't expect March 2020 type of risk off with regard to Bitcoin and Ethereum. Too much is different, as I said earlier in the stream. It's a different world compared to March of 2020. It just isn't the case anymore that this is pure speculation. In March of 2020, the only thing that existed from a cryptocurrency standpoint is really Bitcoin and Ethereum. Nothing existed. There was no Uniswap. It was not even in its infancy. It was like the nerdiest of the nerds, like folks like myself and many others that were playing around with what Uniswap was in Q4 2019. There was nothing. So I guess we started the stream on a good foot. It's different this time. Credit and capital destruction processes are the same always. And heading into the future, I strongly believe in the return of value investing, especially with the higher interest rates. It's very consistent with that kind of statement. Would be less malinvestment, less broad speculation. But of course, we're going to see that degeneracy to a degree. But my expectation would be that it's muted, at least a bit. We're not going to see just gross price action, gross green candles to the upside and just pump and dumps and whatever the hell was occurring in summer of 2020. I would think that capital will be allocated with a little bit more intelligence, which is by definition what value investing is, where you're inspecting balance sheets, you're inspecting volumes, you're inspecting cash flow. That's not fundamentals. Not that, you're not, clearly you have to have the fundamentals there for a protocol to have X amount of volume, X amount of transaction fees because it's being consumed that much. So fundamentals to a degree foreshadows potential consumption of a system. So that's where we're heading, and that's the type of mindset that's absolutely required, especially as liquidity starts to become available and price action starts to go up quickly. Folks tend to get ahead of themselves and frantic, and what do I buy? And you go get all crazy and loopy. But I'm sure we could do a little bit better this time around. I'm sure we've only been talking about this shit for years at this point. I think we're a little bit more prepared to not spread too thin and not over allocate, over concentrate, albeit that's really the end result of a successful portfolio. You sell losers to concentrate into winners. So the end result of a successful portfolio really is a very concentrated portfolio. And then, and that really just reminds me of where we've come from. And I look forward to where we're heading. And it's going to be a much more casual experience, at least for myself, the folks on this channel, folks on Discord, and the folks that follow on Twitter. It's certainly not going to be the frantic experience of years past. So that's the deal. Gazik is in the house. A pleasure. Brian, happy Monday. 12 people stopping by to say hi. Bitcoin pumped to the upside very nicely, 2.89% this AM after 2-year yields. Did some magic mystery shit last night. Let's take a look. I mean, that candle to the upside, obviously I look at monthly charts. I'm not looking at the daily, but if you want to see that wicked candle, folks are chalking that up to an error. But whatever the case may be, that would have easily blown out 06 highs in 2-year yields, and that's a significant component of Treasury composition. So that would have had significant impact on market actors that are dependent on the yield as well as the price point of that asset. Obviously, that asset is collateral, so banks would have a difficult time dealing with such depreciation in a short period of time. It's the volatility that screws up portfolios and balance sheets. And 5% volatility would have been wild overnight. So this AM, what else is going on? DXY seems to have resistance above head, which is very comforting. If you go to the monthly, we're looking for 11 more days for it to find resistance at the time-weighted average price. Albeit, look at that damn Stoke RSI completely reset to the bottom. Albeit, in bull markets, RSI gets pinned to the top. In bear markets, RSI gets pinned to the bottom. So you can't really look to it as the ultimate indicator for a turning point or a directionality change. So we have 11 more days. I look forward to this hopefully holding the time-weighted average price as resistance. Look how many months we're waiting to get a sense of directionality here. 1, 2, 3, 4, 5, 6, 7, 8 months since the breach of the time-weighted average price to the downside. And this is just a retest. We haven't had a decent dip below that time-weighted average price for it to retest to the upside. This is that retest to the upside. And there's a whole bunch of, not resistance, there's a whole endless reasons for the dollar to ever appreciate. And you look at oil prices, what they're doing. That's exactly why the dollar appreciates. Dollar appreciates when you need to buy oil, because what do you buy oil in? It's denominated in dollars. At the margins, and that's what's going on in Russia, at the margins, that has changed, but things start at the margins, and then you have to factor in time horizon for how long that restructuring requires to take place. And it's when you're talking about oil and energy, you're talking about a decade, 20 years, for the margins to become not just the margin. So that is not the average behavior that's expected. The average behavior that's expected is if oil prices are more expensive, the dollar has increasing demand. So oil tends to be correlated, positively correlated with dollars. So that'd be interesting. If you see a divergence between oil prices and dollars, I mean, we've seen currency intervention everywhere, Japan especially. But even if you zoom out to the 6-month on the dollar, how do you think you get these cyclical tops? These are global collusions to achieve these types of directionality restructurings. It's massive directionality shifts. And we're talking about years for this shit to play out. 1, 2, 3 years from top to bottom. January 85, bottom in 88. It was even longer when the dollar topped in 2001. And this is, as I've said many times, this is my most favorite chart that could potentially give us indication of a very, very large-scale structural change, because the dollar's been in a bull market since 2008. And if it tops, if we see that lower high, lower low, I mean, it can play out for 10, 15 years at this pace, because that's '08. That's 15 years ago. Give or take a 6-month interval. Brian, sorry if you covered it Friday stream. What are your thoughts on the CVX proposal on shifting revenue to stake CVX? Well, that's going to do exactly what FXS ETH does with regard to incentives being deployed for FXS ETH on the AMMs, and that ensures that, well, it also isolates that vote rental revenue is for vote locking and everything else goes to staking. So it nicely creates a divide between the purpose of the separate positions. So I generally have a high opinion of it. I think it's a nice change. I'm not quite sure what folks are looking for other than that simple thought, and that's probably the obvious one right on the surface. And I think that's all you have to do to really look into it. I don't think there's any more like secret sauce. If you want a vote lock for that cash flow, that's that cash flow. If you want a stake to have access to all the fees that come from Curve and Convex, and I'm pretty sure FXS is in there at some point, then that is that type of position. So it's a liquid position versus an illiquid position. I think that's the simple way to look at it. Some folks are more comfortable with liquid positions, and some folks are actually more comfortable with illiquid positions. So to each their own, and these are two types of products. Simple as that. Raul's in the house, a pleasure. Sarko, hey Cap, looking forward to more capital inflow. Cowbell, yeah, that's an interesting phrase. Raul says cowbell. I mean, it's not just him. This has been a terminology used for a long time. It's exuberant, has that that flair of excitement. Cowbell, they're going to juice the markets. They are volatility suppressors. The system juices itself, and all the regulators need to do is continue to suppress volatility. If we see continued suppression of volatility heading into Q3 2024, the system has more collateral, especially on the run collateral, that's going to print in 2024 than ever. It's what, like $11.5 to $13 trillion worth of fresh on the runs going to have to be sold next year. That is a tremendous amount of collateral that's used outside of the United States to increase the amount of dollar liabilities in circulation. That's what you use to borrow. You use collateral. So depending on the interest rate, there could be an interesting discount available, depending on, bank underwriting, so on and so forth. But if you're buying at 95 cents on the dollar some U.S. government collateral and a bank lets you borrow at face value, I mean, come on. That could be very interesting. So I basically see the setup for possibly a massive increase in systemic liquidity heading into Q3 2024, or whenever a good majority of Treasury, hits the auction and gets into circulation. And before then, whatever the Fed wants to absorb, whether the Fed's buying it or the rest of the world is buying it. Well, basically the market sees it the same way. It's getting bought, therefore overall composition of systemic liquidity is basically increasing. Whether it's domestic U.S. or international, if it's available to be spent, it usually ends up getting spent. So what was last night with this, the 2-year? Was that Fed intervention? Was that intervention, or was it literally just an erroneous print? And if it was an erroneous print, why hasn't the data been updated? It's neither here nor there. It's almost irrelevant. But suffice it to say, I mean, isn't that obviously something that would have had to happen? If there was a 5% spike in 2-year yields overnight on a Sunday evening heading into market open Monday, either you collapse the regional banking system, their balance sheets become impaired beyond repair, or literally you just buy. So that's the Fed's choice. And that's basically a good part of my comfort. They're going to suppress volatility. They're not going to do, the Fed put, as they've said over the last decade, more or less. And that was relative to equity indexes. And this trend, you can see it more clearly on the 10-year. Historically, they pivoted from a monetary policy perspective relatively predictably on trend. And I don't expect that in any regard. I expect the structure of the system has changed. So it's not the put in the same way, but I would define it as their role in suppressing volatility is only going to increase over time. They're not the put where they drop rates to make sure the interest rates are producing lower lows and proper incentives are applied to put buy pressure on the whole yield curve, whole bond market. They're not going to do it the same way. They have already shown they're not going to do it the same way, considering yields breaking these long-term moving averages to the upside. But that's not what markets need to continue these liquidity cycles that we experience. The crypto space, everyone always thought it was so correlated to equity markets, and it was always only correlated to liquidity conditions. And the difference is flows. That's exactly what the title of the stream is. And flows go to different places depending on underperformance or outperformance. I think the whole composition of enterprise is changing. Thus, the whole composition of equity markets from an investment standpoint is changing. You could speak to that in regards to like growth investing versus value investing. If you look at the broad stock market versus the FANG stocks, the broad stock market is decimated. It's gone nowhere. It's been a tremendous amount of under allocation because everyone's still in that growth narrative. There's a tremendous amount of investment opportunity with smaller companies that are going to change things. They become big companies, and their balance sheets are healthy, and they're growing, and they got cash flow, and they're paying dividends. That's really my base case heading forward for the recomposition of the equities landscape is the reintroduction of value investing. And the excitement that I have for crypto markets is because that value investing methodology is overwhelmingly applicable to these types of enterprise as well. That's the only disconnect mainstream narrative has with crypto markets, is that they still have yet to be specific when they discuss these types of investments in distinguishing between growth and narrative and exuberance and value from an enterprise evaluation standpoint. What kind of business is this? Are they extending credit? Are they facilitating settlement? Are they facilitating liquidity? What is liquidity? Oh, well, this isn't traditional enterprise that you would invest in equity markets. This is still an enterprise, but it's not some shit that has been exposed to Gen Pop in the equity space. You're not buying a liquidity provider or a market-making operation on the New York Stock Exchange. That doesn't diminish these entities from actually being enterprises in any regard. They got balance sheets, they got cash flow, and they give us that cash flow. So not only is it relatively novel enterprise, but it's also enterprise that hasn't fucked over the retail investor like traditional equities has. Too many people, human resources all messed up, malinvestment, excessive salaries for executives and blue collar and management and managers. You don't need it. Automate it. And then you could allocate those resources elsewhere. So this is kind of what I've been saying about the whole composition of the financial system, which encompasses enterprise and how you structure an enterprise. The whole composition of everything is changing. The whole AI narrative is efficiency. We're going to need the same quantity of human resources, which means entry-level jobs are probably going to be really difficult, but the interesting thing is you don't have to start at entry level because you have the intellectual capacity to access what ChatGPT has to offer from a functionality standpoint. You no longer have to remember everything. The world remembers it, and all you need to know how to do is to access it. So types of employment, it's all changing. And what's assured through this entire process? Government will always suppress volatility, especially when it comes to financing social civility. And it's been getting pretty rough out there. So, which means I think they're going to have to finance social civility at some point. I mean, there's only so much a society, a social fabric could take before people really start getting pissed off. Hope that helps. Tapsy's in the house. A pleasure. Shisha, good to see you again. What do you need to happen for you to sell your curve stack? I can't sell my curve stack. It's perma-locked. Simple as that. It was a purchase. It wasn't a position. Hope that helps. Good day, crypto nerds. Always a pleasure, Brady. Always a pleasure. Shinzo Abe, my man. What do you have? Oh no, that's my deck screener chart. Nothing interesting on MAV. I don't see it as an investable asset at this point in any regard. I keep an eye on stuff that is not readily available in TradingView. That's about it. We were talking about MAV on Friday. I think that's why it was up there. Here's what I've learned after 3 cycles by Ethereum. If only I just did that each time. Okay, that's an interesting statement, and you would have done well. That mentality from like a Bitcoin at $500 a Bitcoin would have done well. Same thing with Ethereum at $10. if I held Bitcoin, this was like 16, 17, heading into 19. I had a Tesla stack way before they did that reverse split. And if I held that Tesla position, obviously I went like 15x on the money. It would have been the biggest mistake of my life. Heading into 2020, I had a fair amount of Bitcoin. If I held that Bitcoin stack, you know, it was at what, $4,000 at the end of 2019. It would have been the biggest mistake of my life. Food for thought. So that might be my experience, and it's hard to tell a story about that because nobody will ever have someone else's experience, and that has to do with risk profile. It's not just risk tolerance; it's also luck of the draw, right time, right place, coincidence, causality, one of those words. So you can't compare ever to someone else's hand, but every once in a while I mention my perspective. And my perspective was if I did that, if I just held what I had in 2019, it would have been the biggest mistake I've ever done. Believe me, I wish I had a stack of $10 Ethereum at the amount of capital I had in 2020. That would have been a different story. But I didn't. So you always have to compare based on the circumstance at a particular time. And you can never speculate on what ifs that didn't occur. Everyone wishes they had 50 grand worth of $10 Ethereum. And then you'd be Tetranode. Greetings from Iceland. Always a pleasure. Welcome. I wish the next cycle will give everyone good things. And all I could ever do is hope that everyone does a little bit better. It's a little bit calmer. Doesn't malinvest as much as they may have in the past. And ultimately ends with a portfolio, whenever it happens in 2025, with a portfolio that's more concentrated because you sell off the losers and buy the winners. Sir Joe, still present. Dance in the house, a pleasure. 21 people in the stream, 12 likes. I appreciate all of you. Hit that thumbs up button. Let's take a look at the Ethereum and Bitcoin real quick from a technical perspective. Go to the monthly. So with the bump this morning, it pushed us nicely above the time-weighted average price on the monthly. A lot of folks look to the 200 on the weekly. So obviously it's a resistance level, and you see the wicking there, so it's a decent expression of resistance. And this is the longest bear market in Bitcoin's history. But I like the monthly chart better, and I just tend to really like even longer term charts, like looking at the 3-month chart on Bitcoin. And we've talked about the 3-month chart, particularly with regard to the time-weighted average price. You can see how damn exuberant it was, how deviated it was from the time-weighted average price on the 3-month. So if, on average, if look at the reset on the Stoke, so that's quite comforting. So on average, if you buy below the time-weighted average price on the 3-month, this is Ethereum, you've gone up, period. From a 3-month interval perspective. It is always higher 3 months later if you buy at or below the time-weighted average price. So this maybe comes back to what you were talking about, Mickman. All right. So this works from an appreciation standpoint. It's not productive. I mean, obviously, 4.5% or whatever the hell Ethereum is pushing out nowadays. That could be meaningful if you have enough. So that is a topic of conversation we talk about a lot, but that's neither here nor there right now. What I want my point with this, probably with regard to like entry price and that type of consideration. So you never want to buy with a significant deviation to the upside. So look where we're at. 1656. We are below the 3-month time-weighted average price on Ethereum. Where do you think we're going to be in 3 months? Because it's not 1 month, it's not 2 months, it's not you have a liquidity event and Ethereum collapses to 1200, but then a month later it's back at 17, 1800, we're talking about 3-month time intervals here. On average, if you buy at or below this green/red line, 3 months later, the price point will be higher. This is what I mean by peering through the bullshit. You have nothing on the 6-month. It's way too short of a time horizon to look at. So on the monthly, clearly you get your big dips. Well, that's obvious. But on the other hand, you got the 50 SMA, but we're near that price. So if you bought at the 1400s when everything, bottomed out, that was probably a good price. 1400s. That puts you at the monthly 50. If you go out to 3-month, you don't have those moving averages. Not enough history. If you go to Bitcoin, you got some more data. Look at the 3-month on Bitcoin. A little bit of a different chart. Same applies. At or below time-weighted average price on Bitcoin, 3 months later, it will be higher. That's literally what this chart shows for its entire history. And obviously, it went parabolic back here in 17. 29,660. We're currently below the time-weighted average price for Bitcoin on the 3-month chart. If we go over to the monthly, there's your volatility, there's your moving averages. 26,000 is the 50. If you look at the 50 over the last, this goes back to 2012, so there's a little bit more history, but there was nothing back here prior to 17. Then it just really took off with its cycles. But on average, from 50 SMA perspective on the monthly, look at the trend. In 1 month, the odds are the price will be higher. And that's just based on trend. So if you really want that comfort level, here, these are those price points to look at. Turn off the chart. Turn off the price point. And you look at the averages, and that's how you peer through the volatility. It takes a long time for the TWAP or the moving averages on these long-term time horizons to change direction to such a degree that it doesn't make sense that they change direction. 3-month perspective. It's just up only. It's correlated to global systemic liquidity. And they're about to issue $11.5 to $13 trillion in fiscal 2024. It's going to be a tremendous increase in systemic liquidity next year. Capital flows are coming where? How do I answer that? Here's a good answer. Here. This is where capital flows are coming. What does capital flows mean? When you start to see plus numbers on the delta in available liquidity, that's like walking into a casino with $100,000 in your pocket compared to $1,000. You walk in with $100,000, there's more shit you're going to do. There's more activity that's going to occur. There's more volatility that's going to occur. There's more transactions that are going to occur. That's what flows mean. Flows mean more will occur. And, that's probably where we're at, just regard to the crypto cycle, especially with Bitcoin narrative, so on and so forth. We're probably heading into a slightly increasing liquidity environment, change from a negative sum game to a marginally positive sum game. We start to see depreciation fade away, stability be the base case, and maybe a little of appreciation and maybe even a little bit of exuberance. But that's a very interesting period. As I've talked about, that's what I'm looking for. And I vividly remember in 2014, 2015, I remember Bitcoin going from $250 to $500, and I remember it was like $400 and change dollars. And I bought a bunch of stuff. I bought a bunch of bed sheets back in the day. Bed Bath and Beyond accepted crypto. Go figure. Was it Bed Bath and Beyond? No, it was Overstock. Overstock.com. And I remember thinking, eh, let's use it. I don't see the price going anywhere. This was all those years ago. So this is that period where it's not down, where it's relatively stable, where negative sum isn't the prevailing direction, and things are, stabilized. And to me, what I've learned over the last couple of years is that's an extraordinary thing, because this is a market that is so easy to be volatile. And if shit is not volatile and it's stable, that's incredible. And you got to remember, we're coming from the perspective of value investing, where we're looking for cash flow, we're looking for volume, we're looking for that volatility, but not in the price points of the assets that I'm most interested in. I'm not looking, and I've said this many times, I'm not looking for asymmetric returns on curve. I'm just looking for not down. And to me, not down means I made the right choice, particularly because it's supposed to go down, considering the issuance. It's supposed to be a hyperinflationary asset. If you remember when it launched in 2000, what was it, 21, give or take? The hyperinflationary decay in end of 2020. So why isn't it going down? Now, this really comes back to the entire conversation we had about federations and what has evolved as one of our primary topics of conversation. So why is it not down, considering how much is issued? And now a prevailing argument is that it's not issuing enough, and that's the FUD that has circulated about it. What fascinates me most is horizontal price action. Look at these bottoms. Bottom, 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 bottom. It's not straight down. That's because it's consumed. That's the whole narrative of recycling and sterilization. And in an increasing liquidity environment, I'm not looking for price appreciation here. If it goes to $2, $3, if it goes to $4, and eventually maybe it does a level in the next 5, 10 years, gets to $10, that's not asymmetric. That's not getting your 1000x on the money. That's not what this asset is for. In many regards, this may prove to be an extraordinary savings vehicle, relatively stable in price. Now, yeah, clearly this is extremely volatile, but if you're going from 47 cents to $4 in an environment where everything's going 100x on the money, it's a relatively stable asset. It's the outlier with regard to price volatility. And that's because it's a different asset with regard to issuance, with regard to monetary policy. It serves a different purpose. This is that value versus growth. Growth, you get the narrative, you get the asymmetry. Value, you get the damn cash flow. So that's the story I've hopefully told folks, and I'm very hopeful that there hasn't been excessive misallocation based on my narratives. Now, what would be a misallocation of capital is getting the portfolio size wrong. Too small of a portfolio, applying value investing methodology, is probably not going to meet expectations. These are terminologies that are so imperative, which is why we've talked about them of late. Expectations not exceeding what actually occurs creates disappointment. That's not something that you want as you're managing your capital. So you have to set those expectations based on realities, and you really have to understand, you have to define whether you're a value investor or a growth investor. You have to know who you are and how you want to engage with the markets, what type of methodologies you want to subscribe to, who do you want to be. A lot of the things I say are for the experienced capital manager, but I try and sprinkle in things for the novice investor. And the biggest thing for the novice investor is you have to define rules. One of the more recent rules is me defining what is cash. Cash for me is Ethereum, Bitcoin and dollars in varying stablecoin forms, predominantly USDC, CRV USD, so on and so forth, USDT, Frax, cash. And you may find that interesting. Like, why do I define Bitcoin and Ethereum as cash? I won't digress too much, but that's my definition. I pay a volatility premium to alleviate counterparty risk. That's it. That's the simple answer. What do you think is a good percent split of value versus growth in a portfolio? That my man coming out swinging with a great question. Probably heading into the next liquidity cycle, my primary methodology and way I'm going to engage with the markets is relatively restrained. The portfolio is going to grow over time. Cash flow, revenue, weekly revenue. What do I do with that weekly revenue? It's going to be fun to talk with you guys about technicals, and we'll be engaging in trading. We'll be engaging in identifying 2-month ascending triangles, waiting for a breakout, capturing 50% returns on a measured move. That'll be fun. Everyone knows there is a return to easy mode at some point. And for me, that will be with cash flow. You got to remember, like the 3-month TWAP on Bitcoin. You don't want to buy shit that's excessively deviated from the moving average. So that's probably from a value investing mindset. So I'm not going to be necessarily investing through whatever cycle comes next, 24, 25. I'm not going to be investing in the exuberance. I'll be accumulating during the exuberance. And if in hindsight, if you did that and you had all your money from the exuberance and you were investing now, doesn't that make sense? So I'm trying to calibrate to learn from how we did to do better. So surely, considering all that, growth will be a very small percent of everything. We're talking, what have I said? 0.1% to 1% changes everything. All right, so if it's an up-only mode and you're throwing around 1 to 5% of the portfolio, 1 to 5% of the cash position, isn't that what like Peter Brandt talks about? Is like 1%. You're not making bets with large chunks of the portfolio. You're only making bets with small parts of the portfolio, because if you turn a small part of the portfolio into a large part of the portfolio, everyone's happy. So that means basically a good split would be like 90-10. 90% cash flow, you already own everything at the rock frickin' bottom. Either it goes down further from here and then goes up, or it's relatively stable and comfortable here and then goes up. Then your cash flow goes up and you see what survives, and what survives is going to produce more cash flow. And what do you do with that cash flow? That cash flow, you allocate a part of it to growth, speculation, trading, and the other part of the cash flow is for you to live, and that's the whole point. The most important thing for a novice investor to learn is what I've talked about a long time ago. I did a podcast with my wife, how to use what we do, how to use crypto, how to spend it. The first thing to learn is how to spend your damn crypto. Because the whole point is to have it work for you so that you have it to spend, so you didn't have to work for it. So that's what you do with the majority of your cash flow. You don't gamble with money you need, you gamble with money you don't need. Hope that helps. It's an interesting conversation, though, and I'm sure it'll evolve more, especially as exuberance becomes more prevalent. And we're gonna be the calmest stream in all of crypto whatever, when exuberance is everywhere, and it's gonna be, all right, guys, we're looking at this. It's gonna be so calm. Everyone's gonna be running around like chickens without heads, and we're just gonna be here talking like we always do. You're welcome, Dan. With the ETF, but inflow to curve is going to be hard to revive the Ponzi again. Well, it's so easy to throw around that word. Um, it's a bit of a loaded statement. There's a lot to digest there, and I'm not going to break all of it down. I look forward to the ETFs. ETFs drive in more buy pressure. That's it. That's what an ETF does. It means folks that only have access vis-a-vis traditional financial rails now have buy pressure to put it on their balance sheet in a, encapsulated in a traditional form, in an equity, an ETF. So it's accounting and the regulations all make sense for them. So that's all it is. So ETF means buy pressure from a different liquidity pool. But the second sentence, folks got to be careful with that word. It's a loaded word. This asset that we're looking at here, the price point is not reflective of the service and functionality it provides. Price points don't tell the entire story. What tells the story is the actual functionality and what it does as an investment. This asset that has bled from $7 and change to 44 cents has made me more money that I make in my job, almost twice as much. In fiscal 22, it made me about twice as much money as I made working. And in fiscal 23, it's going to be more than my job, but it's come down. But all of this is considering a decreased liquidity environment. So if you factor all this in, the only thing I did wrong was the entry price, because we were still exuberant and I was still learning these methodologies and defining these narratives. So the only thing with regard to the functionality, what it has done, the only thing was the buy price. I wish I bought it cheaper. But I think everyone in this forum has made that mistake in 2020 and 2021, as we all ran around like chickens without heads. Hope that helps. FXS is the hard one because it's not productive, but general consensus indicates that it will be. Listen, the entire good part of this entire stream, and I'll wrap it up soon, I promise, is we talked about the restructuring, recomposition of the global financial system, recalibration for higher yields, higher lows, higher highs on yields. How fiscal handles that and, how they make that work, that's another story. But the point is, that's the directionality. That's the breach. That's the whole point of what we're seeing in the data. The trend breach to the upside. And you see that best by turning off the price point. Hide the price point. And you go out to the yearly on 10-month bonds. And then you hide everything. And you could even hide the moving averages. And this is 1925, looking at 10-year bonds here. Look at the green time-weighted average price. It takes a lot to move a time-weighted average price. And this is at the yearly interval. When you see a green time-weighted average price, this is a structural change. You're not going to go lower. There's no return to normal. The system is recalibrating. And what does that mean? Why we start talking about this with regard to FXS? The entire system that they're building is based on these risk-free rates, sovereign debt instruments. It's a big deal. So I think that is quite a reasonable statement. To such a degree, it's the composition of the portfolio. It's the only speculative value instrument that has been part of the portfolio for a long time. Now, the narrative that I had when I first took the position has clearly evolved, but that's where I'm at. Speculative value, the speculative cash flow could potentially be quite significant. So that's how I classify. It's imperative, as novice investors learn, to start to classify components of the portfolio that have different purpose, different stories, different narratives. So that's my classification for Frax. Tape Pusher, would you consider locking CVX or CRV in the Union, a decent position for small portfolio heading into 2024? Locking remains liquid, I believe. So it depends on your interests. If you wish to retain a productive asset in a liquid position, it's because you wish to capitalize at some point. I don't expect these assets to significantly appreciate. And when I say significantly appreciate, clearly a 5x or a 10x, that's probably reasonable for the kind of volatility we're expecting in crypto markets. And that's not exuberant. So, you know, in that regard, a very popular protocol that we talk about often, curve convex, the federations, or a balancer, they're not necessarily good investments for smaller portfolios. And that's just probably a rational statement at this point. There's probably other things that will significantly appreciate it. Maybe if the portfolio is small enough, you just wait for up-only mode, in which case it's not even necessarily my content that's the best to look to for guidance. It's maybe like RT at Hero Labs or some of the more famous technical traders, and maybe it's yourself getting acclimated to technical patterns and the indicators. I guess this is just one indicator. There's endless indicators. And then making speculative bets with proper stop losses and maybe twapping out and using Uniswap to do limit orders, and it's, I mean, literally they have limit protocol. I mean, 1inch has had limit orders and free Ethereum swaps since since forever at this point. So that was just a big argument for a while. Ethereum transaction fees, especially when they were like $500 a transaction fee, and you could literally go on Uniswap and do free limit orders, free. So I don't have a simple answer. I mean, 2% fees are fine. I think I'm paying 10% on Paladin or something like that. Or was that Hidden Hand that has a 10% fee and Paladin is significantly less with regard to their fee on VL Aura and VLCVX. So you will have to make a choice on what kind of activity you wish to engage in, which means it's probably time to wait for the smaller portfolio. Wait for when you start to see this 1%, 2%. Or what you talked about earlier, just dollar cost averaging and accumulation. And literally, Ethereum could easily pull 10x. My base case is I'm looking for like a 5x on Ethereum. Bear in mind, Ethereum, I don't treat it as an investment. It's the cash position. I have things I want to do with that cash position. And at 5x its current price point, I could do the things I want to do. So I'm not looking for a 10x. I don't give a shit if it goes up to 10x. I'm sure as hell not waiting for all-time high to liquidate these positions. I'm looking for a specific price point to do real-world things, in which case there's more cash flow from assets. So maybe the narrative evolves in the coming years that at these price points for Curve and Convex and others, Concentrator and Cleaver and all the other stuff, Prisma could be interesting. It's a bunch of them. It's endless, and that's the whole point. How many more do you think they're going to be? That's what gets me excited. Maybe it turns out these are an incredible savings vehicle. A way to save in a relatively non-volatile asset. And non-volatile, I know, it went from $7 to 40 cents. But something that went from, Luna, come on, there's plenty more volatility than the volatility we see here. That's just the way it is. So this could turn out to be a very interesting savings vehicle, and then you have to think in terms of where do you get your cash flow? Is it cash flow from work? Then you also have to set goals. I know where I want to be in 2025, 2026. I'm thinking in terms of that time horizon. I think in terms of 2030. What is my expectations? So my expectation, my goal is to accumulate enough cash flow assets that I could click a couple buttons and get my cash flow instead of work. That's a dividend investor's mentality. It's not like I'm being uh, optimistic about the crypto markets. This is literally the classic dividend investor's mentality. If you have $5 million and you put it in 2-year government treasuries, you're getting $250,000 a year, give or take. Okay, that's pretty cool. So the whole goal with regard to dividend investing, the traditional mentality, is to have enough capital where the capital works for you. So I can state that I think that opportunity is much more available in the crypto markets. I think the base infrastructure, the foundation of a lot was built in 2020 to 2022. And it's not the new shit. The new shit's going to be built on the old shit. And the old shit is the stuff that's going to be trusted, that has the lendiness. So that's where the more capital will flow. Flows. Flows occur based on adjusted risk. Less risk, more flow. So it's not necessarily the new shit that outperforms the most. Rootstock. Ooh, haven't heard that a bit. Yeah, I have a high opinion of Rootstock, Syscoin. I've had that Syscoin masternode for like, I don't know, over a half a decade at this point. Um, but I like the Bitcoin EVMs. They could be interesting. Now, bear in mind that's speculative, and that capital was long before I had any of these narratives, so they've just been operating. So that could be very interesting. I don't know. I don't know what's going to play out with Bitcoin and smart contract land, or maybe it just is just collateral or is just cash as I treat it. So you could speculate in that regard. That's what I'm doing with Syscoin. Not rootstock for myself, but why not? So I think that there's interesting things that could potentially come from EVM contracts that are secured by Bitcoin. That means a lot. I mean, Bitcoin security it means a lot. What do you consider a small portfolio? Well, you know, a small portfolio is dependent on how much work it could do for you. Listen, if you have 10 grand, and it also depends on your expectations. If you have 10 grand and you can make 25% a year, which is a relatively high rate of return, but you need a high rate of return to account for risk-free being at 5%. I've seen a lot of dividends at 7, 8, 9, 10%. It's like, who's going to deploy to that? No, you need to get paid more to account for where risk-free is at. So let's say 25%, and you have 10 grand. If your expectation is $2,500 a year, and the expectation is for it to pay your car finance or car lease, or you have a small, I don't know, but that's my point. My point is, if that income can pay for something, that might be the expectation. So a small portfolio is dependent on expectations. But if your expectation is to turn like 10 grand into $10 million, you're not going to do it with cash flow assets and value investing. You're going to have to explore the growth side and the narratives and the shit that's hot and the social media and the trending stuff to get those kinds of multiples. So the size of a portfolio, the classification of a portfolio is certainly subjective. I mean, come on, which country? 10 grand portfolio pulling in $2,500 a year could be pretty damn interesting in a lot of parts of the world. Or maybe 10 grand is you don't even need that. A couple of grand pulling in an extra $500 a year could change people's lives. So investing is dependent on geographical considerations as well as expectations. So that's how you would have to ultimately classify uh, a small portfolio. And for myself, my subjective opinion, is mostly irrelevant. I can only think relative to me. Everyone has to come to these own conclusions themselves subjectively. Why couldn't Curve be moved to a Bitcoin layer 2? It can. It's not about moving it. That's the whole cross-chain, seamless cross-chain interoperability narrative. It's everywhere. The contracts are built. It's EVM is critical mass. I mean, it just is what it is. You deploy EVM on Bitcoin. I don't think Syscoin is on Curve isn't on Syscoin, but there's a shitload of stuff going on Syscoin. Very interesting EVM. I mean, even multi-chain was facilitated cross-chain liquidity there. But if there was more popularity, I'm sure Layer 0 would hook in. But you have to do what the market demands. But it's not about moving it to rootstock. It's that if there was actual activity or a need or a demand for it there, you pop it on governance and you deploy it on rootstock and you deploy it on wherever. That is not even something to think for a second that wouldn't be done or can't be done. Have you looked into Hype Cycle at all? I have not. Not familiar with what you're referring to. Monday, September 18th, 12:32 p.m. Thank you all for joining me. 26 people made it to the end of the stream. Looks like this market is getting interesting at some point. I'm very hopeful. 17 likes. Hit that thumbs up button. I appreciate all of you. Tell everyone to subscribe because we can do better in the next cycle by being rational. In the description, link to Discord, the most rational community in the entire crypto space. I appreciate everyone there, everyone surviving together, and I'm sure in the next cycle we're going to have an interesting time, and we will be the most calm, lacking of degeneracy community in the entire crypto space. I'll see you again later this week. Peace.